Hey there, everybody. We are back with our roadshow interest rate tour. And who knows if that's what we've called it before in the past, but that's what I'm calling it today.
We've switched it up a little bit.
Who do we got with us today, Matthew?
Well, a longtime friend and great lender in town. Just switched over. Oh, gosh, I'm spacing.
I'm not.
What's the name of the new company?
When you get to the top of a hill, you're at the Hilltop.
This is breaking news, actually, because when we release
like
this video, it might be the day that this is being announced to the public.
We're like real journalists almost.
Hilltop Home Loans. Well, the one and only Aaron Callahan, who's been doing this for a long time. And he's actually a mortgage broker, which is different than the typical retail lenders you see out there. What is the difference, Aaron?
So big difference there is that retail lenders sell their own product and retail lenders employ people to sell their product. So when you're dealing with a retail lender, one of the things you can know right away if you are is if they only have one product to sell.
Okay.
And typically what that means is that unfortunately, sometimes with the retail lenders, they can be a little higher than brokers because you have to bake in the cost of employees and healthcare and all that kind of stuff. With a broker, what you have is I have access to multiple lenders, so I can shop multiple, just different programs, different rates, who's jockeying for the best. And because I'm on my own and I cover my own costs, that's not baked into the rate. So a little bit more of advantage there depending upon the situation. So,
yeah, that makes perfect sense. I mean, you're kind of in this co-working space. You just have to pay for a little office space, not
much
full-time
overhead.
staff and build it. Yeah.
Everything's very digital these days. So
Yeah, that's great. You're just keeping up in this modern world.
that's right.
Well, so that actually leads us into exactly what we're going to talk about today with Aaron. And because you're talking about, hey, what you're getting at is, hey, I can actually maybe save folks a little bit more money. We're looking at a market right now. Interest rates are getting
Ridiculous.
destroyed, even last week, today. And so people are getting pinched. Buyers are getting pinched. Sellers are kind of freaking out. We have a lot of listings that have sat longer than we've wanted them to.
Yeah, we're having to have the price reduction talks. I don't think that. Well, I think we have had a couple months of declining prices. Nothing super drastic, but as we see these sellers, being forced with this decision to do a price reduction, and buyers being wary of these new higher interest rates, what are some tricks to kind of get around that obstacle or those obstacles?
Great question there. So. There's a big difference in today's market. When you take a $500,000 or $600,000 home at 3%, and now we're at like 5.25%. That's about a $700 monthly increase for a buyer. That really puts pressures on their pocketbooks and really makes them really draw back on whether or not they're going to buy that home. One of the things that you can do is, I think it's time to get back to the idea of seller credits. That's great for the buyer and the seller. So say you take a property you offer price is $600,000.
Okay.
And all of a sudden the buyer says, hey, I can't afford this, but I can afford $50,000 price reduction because at the rate of like 5.375, that's where I need my payment to be, which would be about $3,079 principal and interest. Instead, what you can come back and say, or what the buyer can offer to win a bid, or the seller can offer to keep the price up, is a big seller credit. You give a 3% seller credit on a $600,000 home, that's going to be about $18,000.
Yep.
What that does is that allows the buyer to go out and buy down their interest rate, buy out mortgage insurance. For example, on an $18,000 seller credit, the buyer can get anywhere from 3/4 of a point to a full point buy down in rate.
Yep.
How that translates is you take, for example, our $600,000 loan, that takes that payment at $600,000 with the 3/4 point down to $3,084. That's almost exactly what their cost would be at a $550 loan amount without the price reduction.
Okay.
If they get a full point, they're actually at $29.95. So they actually get a lower cost per month with $18,000 in seller credit than they do with a $50,000 price reduction on that property. And you only did that for $18,000 instead of a $50,000 price reduction.
That's what we call a win-win.
That's
Aaron.
a win-win. Also,
win-win.
another thing they can do with that is a lot of people don't know that you can actually buy out mortgage insurance. So a lot of people get afraid we're putting down less than 20%, then we're going to have mortgage insurance. But you can actually take that seller credit and you can actually pay a one-time fee to buy out your mortgage insurance. For instance, if somebody's putting down 15% and they got a high credit score, they can typically buy out mortgage insurance for like $1,800. Now you don't have any mortgage insurance. If they're at 90% or higher loan to value, you can usually buy it out for $3,000 to $7,000. Again, with that $18,000, that plus the buy down of the rate can shave off $400, $500, $600, $700.
All right, I'm going to put you on the spot with another question, though.
For sure.
Specifically with mortgage insurance.
Yes, absolutely.
So, for those of you that don't know, FHA loans, mortgage insurance is now on for the life of the loan. It's not.
Always.
It doesn't get to just get shed at the
Correct.
20% equity. Is that still available for FHA buyers, or are you only talking conventional?
No, only conventional. And the reason for that being is FHA isn't truly mortgage insurance. When you're doing a conventional loan, you have private mortgage insurance. That's a policy.
Gotcha.
When you're doing an FHA loan, that loan is completely guaranteed by the government. If the government
Okay.
defaults, they're going to pay off that loan. Where do they get that money to pay off that loan? From the mortgage insurance that you are continually pumping into the system every month.
That's okay.
That's why it never goes away.
Gotcha.
interesting.
Well, that's good to know. So these are really good strategies.
Correct.
Probably more for the conventional box, but that's where the vast majority of people are living anyway.
100%. Yeah.
As you can tell, this guy knows what he's talking about. We have so many great lenders here in town, but as with the other ones, having a lender and a friend is really cool. And so
100%,
thanks for spending time
Thanks
with
for
us
having me.
today. That was some great info.
It was great.
Maybe we
info.
can keep this going. I like this series.
This is a good series.
I'm learning lots through it, actually.
I know. I'm feeling. Yeah. I mean, even the question I asked Aaron, it's like I'm just osmosis, just learning. So,
No worries. We're here.
hey, congrats on the new venture.
Thank
too.
you so
Yes.
much. Exciting.
Yeah.
It's just
Check
time
him
to-
out.
Hilltop Home Loans.
Hilltop Home Loans.
.com.
HilltopHomeLoans.com.
There we
Coming
go.
soon.
Coming soon.
Love
Thanks,
it.
everybody. Enjoy your Tuesday.
Take care.
See you next week.
Hey, thanks so much for watching today's video. If you haven't already, make sure to follow us on Instagram and Facebook. Our handles are shown here on the screen, and you can always find our contact information or more about us on www.buysellbend.com. Thanks.